Retirement planner for Hapoalim, advising clients on all things related to income tax, pension plans, investment paths, and so on. Prior to this, he was an international advisor for the bank relating to investment portfolios. So he knows his way around investments. I think that's fair to say. So naturally, today we're going to be talking about pension plans. Now, this may sound like a subject for the far future for some of you. I know for me, that's what it seems like, but pension plans are crucial to making sure you've provided yourself with a financially safe and comfortable future. And as the new year does come around, well, has already come around now, it's the perfect time to check your finances and make some smart resolutions. Gideon, you're definitely the right person to help everyone figure out just that. And thank you for joining us today.
Thank you. You're welcome.
So, for a lot of us, retirement, like I said, feels so far away. Statistically speaking, people are living longer lives, therefore they work for longer, and that's only expected to rise. But what does that mean for our pension plans in reality?
Okay, Tamar, first of all, you're absolutely right. For many, many people, pension is kind of lifetime away. From my experience, people of the age of 50 to 75 tend to consult more than younger people. Young people many times feel detached or have some sort of psychological fear. When I meet clients, I try to explain them that pension advice should be perceived as long-term financial planning. Because life expectancy is getting extended, the public has to be aware of the need to save more, save from an early stage, work more, save constantly, follow and analyze the evolution of the funds over time. At the late 90s and early 2000 years, the industry has shifted from what we call defined benefits based pension funds, קרנות ותיקות or פנסיה תקציבית, to defined contribution based funds, which is קרנות חדשות or קרנות צוברות.
Important vocab words for anybody who's trying to learn for this specifically for Israel, by the way.
Yeah, this shift has resulted in the need of the public to set a new target function, which is enhancing accumulation over time, as we cannot impact life expectancy.
So can you give an example of how this happens in the real world? Because I know that this so far sounds a little abstract.
Yeah, so new pension funds are the primary saving instrument of the public. They pay an allowance as of the age of 60. The way the allowance is calculated is by dividing the accumulation at retirement, the saving accumulated at retirement, by a life expectancy denominator. The denominator is reflected by various factors, such as, of course, the life expectancy, such as the discount factor or interest rate, the age of the person who's taking the allowance, its marital status, and some other factors. As a rule of thumb, the denominator, the life expectancy denominator for a man at the age of 67 is 200. You can think of it as 200 months or 17 to 18 years. So if as an example, we take this man who reached the age of 67 and he has a denominator of 200 and has accumulated 1 million shekels, he should expect to receive an allowance of 5,000 shekels a month throughout his life. Another way to look at things is to calculate the allowance received at retirement given different starting saving points. So as an example, a person who's 30 years old and is making provisions on a salary of 20,000 shekels a month should expect at retirement to receive an allowance which is higher by around 5,000 shekels from a man starting saving at the age of 35, 5 years later.
So like the earlier the better.
The earlier the better, of course.
So let's zoom out for a second here. I mean, beyond like understanding what the big deal is about pension plans, why should younger audiences specifically care?
One of the, I'd say, main themes I analyze and refer to during an advisory session is what we call the substitution rate, which is the ratio between the allowance at retirement and the income prior retirement. Young people should care about their pensions unless they want to face a significant reduction in the standard of living, in income, in the cash flow when retiring, i.e. substitution rate, which is lower than 1. When I sit with clients and analyze the pension portfolios, I give them a prediction of what would be the allowance at the age of 67 for men, at the age of 64 for women. And what I do is, first of all, I base my assumptions on the current provisioning structure. I take into account some assumptions regarding the profitability of the pension savings over time, and we use some future value models. Another thing I want to say is that the beauty in pension advice is derived from the ability of the advisor to provide the client with practical tools of how to enhance accumulation and enhance basically the pension at retirement.
Get the biggest bang for your buck, so to speak.
Yeah.
So pension plans, you're making it pretty clear. Pension plans are not an easy thing to work around. So first of all, respect to the people who do that as their trade, like yourself. What are some common mistakes that you see when a newcomer seeks your counsel on the subject?
I said I see several mistakes. I mentioned several mistakes. One big mistake I see that people being complacent, meaning they tend to request advice at a relatively late stage in life. A second thing is that people not making sufficient provisions, especially self-employed. People not maximizing tax benefits, choosing a saving scheme non-optimal, non-optimal in terms of the management fee, in terms of the life expectancy denominator, instead in terms of the structure of the insurance cover. People withdrawing funds, severance funds, when they finish work, change employers, or study funds after 6 years. Another mistakes people are making is when they finish work with an employer, they receive grants and severance funds, and they pay tax where actually they could be tax exempted. People, when it comes to the risk composition, choosing a risk composition which is non-optimal and non-compliant with the risk profile, their age, their liquidity needs. And last thing I would say is changing frequently the risk composition of the funds they hold.
So there you go. There's a list of things not to do when you're starting off with your pension plan. We hear a lot lately, especially now with the new year having rolled around, about the dire state of the market, the concerning state of the economy, rising interest rates, rising gas prices, energy prices, employment statuses. How is this, the rising interest rates and inflation on the rise? How does it affect our pension plans, and how should we be looking to invest in such a state of instability?
Pension funds, study funds, severance funds, provident funds, insurance schemes are all invested in the market, and therefore underlying assets are sensitive to market changes. Yet, the new pension fund, Keren Pensia Hadasha, is the least sensitive among all the instruments. And this is because 1/3 of the savings, or 1/3 of the provisions made, up to a ceiling of 4,300 shekels a month, are entitled to receive a government guarantee in the form of a CPI-linked scheme, giving a return of 5.15% above inflation. So if For example, we take the year 2022, where inflation was running at a pace of 4 to 5%. Obviously, the new pension funds provide a safety cushion for the savers because of this government guarantee scheme. And therefore the fund is less sensitive. Other instruments are fully invested in the capital markets, and the sensitivity or volatility depends on the weight of risk assets within the fund. And when I say risk assets, I refer to equities, equity exposure, under non-liquid assets, non-investment grade bonds. As a pension advisor, I tend to look at investments with a kind of a long-term approach, more strategically rather than tactically. I focus, this is very important, I focus in my recommendations on determining an age-related scheme to clients where the older the client is, the less riskier the assets are, and vice versa. I also look to diversify asset manager risk. And when I measure the performance of the funds, I look at a longer term horizon, i.e., I'd say 3 to 10 years. I'm not looking at short movements.
Mm-hmm. So only long-term investments in all senses of the word.
Exactly, all the long-term investment notion, yeah.
So if you had to, this is my final question for you, if you had to narrow it down to a small handful of key factors, what are the most important things to do today to ensure that your pension plan is nice and solid, nice and safe?
Okay, so first thing is to consult at an early stage of life, and from then on, consult regularly. Second thing is...
Like a doctor's appointment for your bank account.
Once you start working, whether as an employee or self-employed, open a pension fund and open a study fund. Of course, employees are subject to employers' approval, but these two instruments need to be opened at an early stage in life. The third thing is to maximize tax benefits, to be aware of management fees and negotiate on reducing them, to fit your insurance cover to your needs and your family needs. And last thing I would say, try as much as possible not to withdraw any kind of pension savings before retirement.
Excellent. Gideon, thank you so much for joining us today. I think we've certainly learned a lot from you.
Thank you. It was my pleasure.
Thank you very much.